The new OSFI mortgage rules, how do they affect the Smith Maneuver? So you may have already got a letter from your bank, or you may have heard people talking about it. We've had a lot of people concerned about it, contacting us about there's new rules coming in later on this year for mortgages, and they will have some effect on the Smith Maneuver. And it's a little complex, but it's actually a good idea to really understand that. So we've had a lot of requests for this video. So here's what we're about. So what we're going to talk about today is, first of all, what is the Smith Maneuver for those that don't know? What are the new OSFI mortgage rules? How will they affect the Smith Maneuver? What's the formula in the rules? I'll give you some examples of the effect and the effect on the monthly investment with the Smith Maneuver. I'll give you the best case and worst case examples. How do you manage the process? How do you minimize or eliminate this effect? And how does it affect the Smith Maneuver versus TFSA decision? So those are our topics today. Okay, so first of all, in case you don't know what the Smith Maneuver is, it's an efficient method to use your home equity to invest for your retirement without using your cash flow, right? So, and it converts your mortgage to tax deductible over time. It converts it to, replaces it with a tax deductible credit line as you pay it down. Now, it's kind of a quirky name. It sounds a little odd, but we've written over literally thousands of financial plans, and we found it's very effective in a financial plan for those that want to do it that it's appropriate for. And it very often bridges the gap to give you the retirement that you want. So, like, we'll find we're trying to help someone save for the retirement that they want, and they can't, with what they're doing, they can't actually reach it, so they're gonna have to compromise. But if we add Smith Maneuver into it, often that makes the difference. So they can keep living their life now as it is now and still have the retirement they want. So that it's a good addition in there. It's a kind of a really cool, it's an effective strategy, even though kind of a quirky name. All right, let's talk about the new OSFI rules. So they talk about, they call them CLP, which is combined loan plans. So basically what they're saying is a readvanceable mortgage, which is what you need for the Smith Maneuver, will not readvance dollar for dollar if your total limit is more than 65% of the value. Okay, so if for example, if your mortgage payment, you pay the interest portion, if the principal is $1,000 a month, it's reducing your mortgage by $1,000 a month. Then what's going to happen is, right now you get the entire credit, 1,000 credit available in the credit line that you can use to invest. Now it's going to be less than 1,000. So that's basically what the effect is. And what it does is it reduces your borrowing limit from 80% to 65% over time, like slowly. So, right now, this is effective when your mortgage comes due after October 31st. And that's because, well, basically all the major banks have a fiscal year end of October 31st. Okay. So, for example, if your mortgage comes due, 5 years from now, you're not affected until the mortgage comes due. Now, I'm just going to read this. This is the actual write-up from OSFI. You just kind of see what they're saying. It's a little wordy, but just so you see it. So, for most borrowers using combined loan plans, these changes will have no effect on the way that they use their products. So most people are not doing Smith Manoeuvre, not using nearly all their credit available, so it won't really affect them. For those who owe more than 65% loan to value, there is a gradual period where a portion of their principal payments will go towards reducing the overall mortgage amount until it is below 65% of its original loan to value and not be readvanceable. This will typically happen the next time borrowers renew their combined loan plan after the end of October or December 2023, depending on the lender's fiscal year. Okay, that's the actual OSFI quote. So now, how's this going to affect the Smith Maneuver? So bottom line, the effect is moderate. It's not major. It's there, but it's not really huge in most cases. And it's a modest change to the monthly cash flow, which basically means the amount that you can invest every month without using your cash flow was probably going to be a little bit less. So, for example, if you maximize the Smith Maneuver, if you're always trying to maximize it, keep everything at 80%, then the new credit available after each mortgage payment will be about 20% less. So if you're paying $1,000 a month on your mortgage and you're investing $1,000 a month, now you'll be able to invest $800 a month. Okay, so see, it's not the end of the world, but it does have an effect. So now, if your mortgage is small, the new credit available after each mortgage could be 80% or less. So that's kind of the worst case, where you still have a high limit of 80%, but your mortgage is really small. And then if your total credit limit is 65% or less of the last appraisal, then there's no effect at all. All right. So basically, the effect is not large. And in fact, the effect of the much higher interest rates this year is actually a much greater issue. A year ago, we getting mortgages like 1.5%, and now they're like 6.5% or a little more. So it's a huge difference. And that's actually a much bigger effect this specific year Now, so what are the new rules? So what it is so you may notice in your mortgage, you have two different credit limits. There's a total credit limit of 80% loan to value and the variable credit limit of 65% loan to value. Okay. So the total is the total that you can owe and all the different, like, often in a readvanceable mortgage, you can have multiple mortgages and credit lines. It's the total limit. The variable credit limit is the credit lines. So not counting anything that's in a mortgage, but anything that's in a credit line can't be more than 65%. So that's what you have. That's the way it is right now. So, all right. So now what the new rules do is they reduce the total credit limit from 80% to 65% over time. And when I say over time, what it means it's over the amortization, over the period of time that your payments are paying you down your mortgage. So if you're paying it down slowly over 25 years, you're just going from 80 to 65% over 25 years. So it's fairly slow. Okay, so now the loan to value, just to be clear, it's the amount owing divided by the value of your home on the last appraisal. Now the credit readvance, so there's two steps to this formula. So we want to figure out how much can you reborrow here now, right? So you make a mortgage payment, you're paying some principal, how much can you reborrow? So there's two steps to it. The first step is the reduced credit. Let's figure out how much reduced credit you get. So that is the principal, this is the actual formula. So it's your principal payment, so let's say you're paying $1,000 a month, times 80 minus 65. So 80, whatever your credit limit is, minus 65, times or divided by the loan to value percent of the mortgages that you have. All right. So that's what the formula is. Okay, so the credit readvance equals principal payment minus reduced credit. Okay, so if your payment was $1,000 a month, now it's times 80 minus 65 over the value of your mortgage. Then the amount that you can reborrow from the credit line is what it was before, the 1,000 minus the reduced credit, which might be $200 or something. Okay, so now what they just want to make clear is the credit limit for most people is 80%, and that's why I'm just using that as an example. But it isn't always the case. It might not be the case. Like you may not have been approved for the total originally, or as this process goes on, you'll eventually have less than 80%. So it's not always the case, but that's normally what it is. Okay, so here's some examples. So I'm going to show several examples. So this is when you first start the Smith Manoeuvre as you maximize it, and I'm going to show what happens kind of over the years. So first of all, let's say your home value is $1 million on the last appraisal. The mortgage was 800,000. That's 80% of it. So that's your total limit. And so initially there's no credit line at all. So your total always 800,000. Your loan to value of the mortgages, so they look at just the mortgage portions, is 80%, and your total credit limit is 80%. Okay, so now let's say your payment is 5,334, which pays it off like just under 25 years. And I just did that, so we show it's exactly $1,000 a month that you're paying off of principal. Okay, so now in this category, we take our formula that's there. Reduced credit equals principal payments times 80 minus 65 over loan to value of mortgage, converts to 1,000 a month times 15. The 80 minus 65 is 15 over 80, which is roughly 20%, so equals 188. So what happens is your credit limit, your overall credit limit will be reduced from 800,000, and it'll go down by $188 to $799,812. Okay. Now the credit readvance equals the principal payment minus the reduced credit. The principal payment is that 1,000 a month. The reduced credit is 188, so you can reborrow to invest 812 instead of 1,000. Okay, so the old rules, you would have got the whole 1,000 that you can reinvest. Now it's 800 or 812. Now let's take this same example. Let's just flash ahead a few years, and what's happened. So now you paid your mortgage down from 800 to 700,000. Okay, your credit line is 80. So now notice your total credit limit here is 78, not 80%. So it's been reduced a little bit as you paid it down. Okay, so that's how you get to the 780,000. And now the loan to value of the mortgages is 70%. So that's the mortgage is 700,000 out of the million. So the million, your home may be worth more, but it's still based on whatever the last appraisal that the bank did for you. Okay, so yeah, now the payment is the same. Now what's happened is because the mortgage is lower, your interest is lower, it's 3,800. And so the principal is now 1,542 a month instead of 1,000. Okay, so now your reduced credit, we'll do the same formula, but it's 70, it equals the principal payment minus 78 times 78 minus 65. That's your new limit minus 65. So it's coming down, divided by the loan to value of your mortgages. So that ends up being $1,542 per month is the principal, times 13, which is 78 minus 65, over 70%, which is where the mortgage is now, 700,000. So now your credit's being reduced by 286. So notice it's speeding up a little bit how it's reducing it. As your mortgage gets a bit smaller, total credit declines a bit more quickly. Okay, now the credit readvance is the principal payment minus reduced credit. So it's 1,542 per month. Okay, minus the 286 is 1,256. Okay, so now remember in the old rules, you'd get 1,542 per month, or the existing rules. New rules, you only get 1,256 that you can readvance. Now let's flash ahead this one, quite a few years later when the mortgage is close to paid off. So now you've still got $1 million appraisal, $1 million value of your home from the last appraisal. The mortgage is all the way down 150,000. Okay, and that's kind of the minimum it can be, because if the credit lines can't be more than 65%. Okay, so now the credit line balance is 630 or 530. And notice at this point, your total credit limit has been reduced to 680,000 to 68%. So it's gone from 80 down to 68. It's getting close to the 65 here. Okay, so it's the same mortgage. This is kind of roughly what the number would be 15 or 20 years down the road. Okay, now, so the loan to value of the mortgage is 15%, because your mortgage is only 150,000. Okay, so that's the loan value of the mortgage. Now you're still making the same payment. Your mortgage is only 150,000, so the interest is 812. Now your principal is now 4,522 per month. Okay, so you're paying off the mortgage much more quickly. So let's do the same formula. Reduce credit equals principal payment times 68 minus 65. Okay, so 68, because that's where your reduced credit limit is, divided by the loan to value of the mortgages. So it works out to 4,522 per month times 3 over 15 equals 904. Now notice originally the breakdown was about 20% of the total. Like the limit went from 8,000 down to 812. You got to readvance. And now it's 3 divided by 15, which is again 20%. So the total is still always stays fairly close to 20%. It seems, when the mortgage is declining at the same rate as your total limit's declining. Okay, now your sort of credit readvance is the principal payments minus reduced credit. So it's 4,522 minus the 904 equals 3,618 per month. Okay, so the existing rules, you get 4,522 per month. The new one is 3,618 a month. So now it's 904 a month. You're getting a fair amount less credit. Okay, now you notice you're getting more and more credit each month, but how does this actually affect the monthly investment? So remember, what happens with the Smith Maneuver is you're paying down principal, and you can use it for two purposes. Part of it is use it to capitalize, which means to pay the interest, the tax deductible interest on the credit line so far, and part of it is to invest. Okay, so on these three examples, the new Smith Maneuver, you're paying 812, you get 812 new credit, and there's no credit line, so you can actually invest the entire 812. Now, after a few years, you're getting 1,256 of new credit, but you pay 480 for the credit line. So just to go back for a second, the credit line at that point was 80,000. So that's paying the interest on the 80,000. Okay. And so you're investing 776. And then when it's mostly paid off, you're paying, so you're getting a lot of new credit, but your credit line, see, remember at this point, your credit line is 530,000. So you're paying 3,000 in interest. This is all tax deductible interest, but you're only investing 438. So this is actually an interesting point here, because under the existing rules, the monthly investment essentially stayed flat. So the existing rules, you'd get the entire 1,000 a month, and you could start at 1,000 a month investment, and it basically stays the same for the entire 25 years. It just never declined. Now what you see is it's slowly declining. Okay, and it's getting a fair amount less at the end. Now, there's ways to deal with this, which I'll explain later, but that's kind of the effect. So it used to be you just confidently, you could just set up an automatic 1,000 a month, and that's what you're paying for forever. Now you got to kind of allow for that the amount that you can be able to invest is going to slowly decline. So you probably have to leave a little extra credit to be able to cover for that. Now, the best and worst case examples, just I want to show you how good or how bad it could be. So if you just start a new mortgage, 80% loan to value, 80% total limit, it's basically 20% less credit that you get, right? Actually 18%. So now the worst case is when your mortgage is down really small, let's say it's 15%, but your total credit limit is still 80. So the example I had before, the mortgage was 15%, but your credit limit had been reduced a lot. But here, let's say that you get a new home, okay, you get a new mortgage, the limit's set at 80%, but your mortgage at 800,000, but your mortgage is small, only 150,000. So you got all this money. So it's a good way with Smith Maneuver. You got a great amount, a large amount that you can invest right away because you've got a lot of equity. But in that case, you're getting the credit available about 45% less because you still get the full 80% loan to value and only a small mortgage. So that's kind of the worst case scenario. So how do you manage this process? So first of all, just to be clear, so the amount of credit that you're gaining in the credit line has two uses. You can pay the tax-deductible interest on your credit line, which is called capitalizing it. Capitalizing it, or basically the credit line is paying its own interest, so it's just adding to the credit line, okay, instead of coming out of your cash flow. And then you can invest it. Again, it doesn't come out of your cash flow, but the rest of it you can invest. Now, so the options to adjust this, to adjust for these new rules, one is you just invest 20% less than you were before. So instead of investing 1,000 a month when you start, you're investing 800 a month, and otherwise things go along fine. The other option is you just increase your mortgage payment by about 4%, and then it'll work out. You can still invest the entire 1,000 a month. So you see, those numbers aren't intimidating. They're an effect over time, like over 25 years, it does have an effect, but they're not massive. All right. So a good idea here is to keep a bit of extra credit for the declining new credit available each month. So I showed you before with a different example, you're slowly getting a bit less. So instead of investing, you probably wouldn't invest the entire 812 that it starts with, probably start with 800 or a little less than that, just a little bit lower, so you're not running out. Or you just leave leave $500 available credit to start off with, and that should really cover for you. So this effect is pretty modest. It doesn't really affect the overall process that much. Now, how do you minimize or eliminate the effect entirely? So first of all, there's three things you can do. So first of all, you can renew your mortgage before October 31st for a few years. And then what happens is the rules don't affect you until that mortgage comes due. Now, the thing about it is, initially we thought, well, what you could do is you'd renew all of the mortgages, renew your mortgage now quickly before October 31st, even if you have to pay a penalty and book it for like 5 years or something like that. And then, you don't have to worry about this, till 2020, end of 2028. Right. So, and who knows, maybe things have changed by then. So the problem with that is two things. One is that I guess, most of our clients, the mortgage that they have right now that's coming due is like, 1.5%, and they're getting a new one that's, 6.5. So you don't really want to renew that early. And also, it's the 3-year or possibly 2-year, depending on which week we're looking at, is generally a better deal than the 5-year. The 5-year term is a bit lower, but we think the 5-year fixed, but you're going to pay more for it. And the 5-year variable is not a very good discount off the variable today. So we're not really recommending the 5-year. So, maybe you get the 3-year now. And if your mortgage is coming due, it may not be worth it. It's a bit of an offset. You think, well, let's say it's coming due in January. So you got like 3 months. So you got to pay 3 more months of today's higher rates instead of the low rates that you have on your old mortgage. Okay. However, these new rules don't affect you for 3 more years. Instead of waiting till January, you pay the penalty and do it before, in October. So there's a bit of an offset, but see, since the effect of this new rules are fairly moderate, it's probably not really worth doing. But anyway, so that's number one. So number two, you can reappraise your home every few years, but don't increase the total limit. Okay. Now, so you need a 23% increase in the home value, and the effect is eliminated entirely. Okay. So what happens is, let's say your home was $1 million, you had 800,000 total limit. Like a few years later, you reappraise it. And let's say it's 1,230,000, so it's 23% higher. Then you reappraise it, the home, but don't increase your total limit. Then that 800,000 is below the 65%, and the rules don't affect you at all. So it just costs you an appraisal, $300 or something, and you don't affect it at all. Okay. Now, typically, 23% increase in home value with a historical average would take about 5 years. So you just wait 5 years, reappraise the home, don't increase your limit, and it doesn't affect you at all. Okay, so that's not a bad way to do it. Recently we're a bit of a housing boom now because of a government-induced housing shortage. So prices have been going up a bit faster. So it may not even take 5 years before you can do this. So now, the downside of this is it's generally better to invest the increase limits you get. If you're a growth-focused investor, if your home is worth more and you appraise it for the limit, if you reappraise it, you can increase your limit now, and by that 23%, and then you've got extra money that you can invest. And that's generally a better thing to do if you're growth focused and trying to maximize things for yourself. So, this reappraise a home and eliminate the effect altogether, that may not something you want to do, because you're not getting more money to invest instead of that. But those are the options that you have. Option 3 that you can do to reduce the effect is to create split mortgages. So remember, part of the formula was based on the percent that's in mortgages. So if you have a huge credit line on there, then you're losing the credit, the total credit limit declines quickly. But if you have a small credit line and big mortgages, then it declines very slowly. So what you can do here is you convert your tax deductible credit line to a split mortgage. Okay, so now you have 2 mortgages in your home. So one is your original non-deductible mortgage that you used to buy the home, and one is your tax deductible credit line, and you convert it into a mortgage. So most of these readvanceable mortgages, you can have multiple mortgages. Okay, and then you've got 2 mortgages, and then you'll have one or 2 credit lines in there, which again start at 0 and then slowly build up. But because you try to keep, every time your mortgage comes due, you take all the available credit and the credit lines tax deductible, put it into the tax deductible mortgage. So the total of the 2 mortgages, always stays fairly close to 80%. Then the decline of the total limit is not actually that much. So there's 3 things you can do to minimize or eliminate the effect. So now this is actually kind of interesting. How is this going to affect the Smith Manoeuvre versus TFSA decision? And this is our experience from including the Smith Manoeuvre in a lot of financial plans. And this is actually an interesting thing. It took a little thinking through to come up with this one. But first, let me explain what it is. So let's say you have some extra cash, and you could put it into your RSP, or you could put it in your TFSA, or you could invest it with the Smith Manoeuvre. So what that means is you pay it down on your mortgage, reborrow it from the credit line, and invest it. Okay, so all 3 cases, you have the same amount to invest, and you can actually buy exactly the same investments. So the difference is only just tax. So which one is better? So now with the existing rules, Smith Manoeuvre generally beats TFSA. And the reason is, if you invest tax efficiently, like our clients are doing, okay, then you actually get refunds in most years, and the TFSA is no tax. So TFSA is no tax, but so most of our clients will be getting a refund in most years, because the interest deduction is more than the taxable part. We don't trigger that much tax from the investments. So generally, in the existing rules, Smith Manoeuvre beats TFSA. And then RSP depends on your tax bracket, and your tax bracket today versus what you expect it to be after you retire. So the general rule that applies just for most people today is, so if your income is under 20%, or in the 20% bracket, so less than 53,000 with today's income, that's the lowest tax bracket, then the best thing for you to do is Smith Manoeuvre. Second best is TFSA once your mortgage is getting paid down, and the third is RSP or non-registered. And actually, if you're in that bracket, you probably wouldn't do RSP at all. You just do non-registered. Don't even do RSP. Okay, and the reason is because when you retire, you're going to be in 20% or higher bracket. There's a lot of benefits that are clawed back by the government. So there's a good chance you're in a higher bracket after you retire. So if you're in the lowest bracket, RSP is generally not worthwhile doing. You can just invest in a non-registered account. Okay, now if your income is over 30%, like any of the higher brackets, so in a 30% bracket or higher, so your income is anywhere over 53,000, today, in most cases, the RSP is the most beneficial for you, then Smith Manoeuvre, then TFSA. So that's with today's rules. Okay. Now, if we go to the new rules, what happens is generally TFSA beats the Smith Manoeuvre now. It changes that decision. And the reason is because if you put it in the TFSA, you're investing 100% of the cash, right? You got a 10,000 extra, you can put it all in your TFSA, or if you pay it down on the mortgage, you don't get the entire amount readvancing. Okay, so you don't get the full amount that you can invest. So generally, TFSA is now going to beat Smith Manoeuvre. So now what this means, if you're in the lowest 20% bracket, income under 53,000, TFSA is your number 1 priority, Smith Manoeuvre number 2, and number 3 is non-registered. Okay. If you're anywhere in a 30% or higher bracket, so income over 53,000, RSP is still your number one priority, then TFSA and Smith Maneuver. So here's kind of the bottom line of it. So the existing rules, generally the rule of thumb for most people was no TFSA contributions unless your mortgage will be paid off before retirement. Okay, so you look at how fast are you paying it off. If it's going to be paid off before retirement, that's when you start doing TFSA. Okay, that's the existing rules. Okay, now the new rules, basically it'll be no mortgage prepayments until your TFSAs are maximized. That's going to be the new way. Now, there's going to be exceptions to this, but that's in most cases what'll happen, which means you're paying your mortgage down more slowly, but it's more important to maximize your TFSA. That is kind of a subtle effect of these new rules that probably nobody had figured out, but it actually does make a difference when you look at this tax effects. And because we're tax experts as well, we see this effect. All right, so that's all the topics for today. So again, what we've learned is what is the Smith Maneuver? What are the new OSFI rules? How they affect the Smith Maneuver? What's the formula in the rules? We gave you some examples of the effect and the effect on the monthly investment. And then we give you the best and worst case examples of it. And we give you some ways to manage the process, three methods to minimize or eliminate the effect entirely. And then we talked about how it affects the Smith Maneuver versus TFSA decision, which is an interesting topic. All right, again, so my name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. And it's edrempel.com or unconventionalwisdom.ca because we're in Canada. We offer a free 30-minute consultation. If you're interested in potentially working with us, then go to our blog or just type edrempel.com/talk, and you'll be able to send us a note about the 30-minute consultation. And there's no sales in that at all. We're just trying to find out if we're a good fit to be able to work together. Also, I would encourage you to subscribe to my blog, podcast, and YouTube. So the podcast is edrempel.com/listen, YouTube, edrempel.com/watch. And so if you subscribe to my blog, all that means is you'll get an email once or twice a week. Whenever I do a new blog or a new podcast or something, you'll get an email about it. And then you can watch or read or listen to whatever you're interested in. Okay, well, again, thanks a lot for listening, and we'll talk to you next week.